Hello and welcome to episode 468 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How are you doing?
Well, I'm doing much better than I was last week. So obviously there was no show last week because I was obviously devastated. Anybody who'd read our Instagram post will have seen me put out a post about my cat Bella, who I've had for, well, it feels like forever, and unfortunately I had to put her down. So I was devastated. And now, one thing I would say is that I put a post out on Instagram because I wasn't able to do the podcast because I was that upset about the whole thing. And all of those people that reached out, in total, there was probably about 300 people who either liked the post that I created about the situation or wrote messages of support and their own stories about their own pets. It helped massively. So thank you so much to everybody that reached out. I do feel better about the whole situation now. There were some really kind messages among all of those. So I just wanted to say thank you to everybody who did reach out before we get on with this week's show. So, Andy, on that note then, I will go straight into what's on this week's show. So we've got three pieces. It's going to be a relatively, I think, short podcast this week, but we'll see because we do have a tendency to chat around the edges. But I'm going to do a piece about how to improve your sleep. One thing you can do to improve your sleep that is money related. I'm also going to do a piece regarding investing that answers the question or gives some insights into that question about how frequently you should change your portfolio when you review it. And the final piece on the podcast, Andy, you're going to be looking at pensions advice and the cost of it, because we actually had a message from a listener via Instagram who asked us to do a piece on the cost of advice. We're going to do a whole piece on how much pension advice should cost, the benefits, and when you should actually seek financial advice.
Okay, so let's get on with this week's podcast then. Which piece are we going to start with?
So I'm going to start with the investment piece because it's actually the meatier of the two. Now, this was inspired by a piece of research I've just carried out for 80/20 investor members, and it aims to give insight into that question about how frequently you should review your portfolio or make changes to it. Now, you may not know, but I've been running 80/20 Investor for almost 10 years. So the 80/20 Investor service, for those who don't know, is a service where I teach people how to run their own money. So if they want to pick their own funds, whether it be unit trust, investment trust or ETFs, they can do that by using the research. There's tables that I publish every week that uses an algorithm that's based upon or applies momentum, so they may be able to use some of that information to apply it to their own investments. And as I say, I've been doing it now for nearly a decade. I don't know where the time has gone, but it does mean there are some really interesting insights you can get from actually investing in the real world. So a lot of the stuff you might see or comments you see made by experts are based upon sort of theory, not necessarily about running their own money. So a key part of 80/20 Investor is I run my own £50,000 portfolio. I say it's 50k or £50,000. That was what it was valued at when I started. Obviously it's much more than that now. So I actually run an investment portfolio and do things in the real world. And as a result of that, one of the bits of research that I carried out this week, which is interesting, is looking back over the 10 years that I've been publishing the short list of funds that I do each month. So it's a short list of funds that are displaying momentum at that point in time. So low risk funds, medium risk funds and high risk funds. And it's a collection that is a subset of a wider list that I update every week. And what it means is that I've been publishing the short list for the monthly list of 30 funds every month for 10 years. Now, that gives a really interesting opportunity then to go back and look at what would have happened had you built a portfolio from those funds, but also what would have happened if you'd actually only picked the funds every, say, 3 months or 6 months, made changes to a portfolio, or just had a portfolio of the initial funds and then made changes once a year. So it's almost like a lazy way of applying the process that I use in 80/20 Investor. Now, 5 years ago, somebody asked me the question about how regularly should they review their portfolio. And of course, there is no definitive answer to that. So what I did at the time was go back and say, well, here's what would have happened had you applied the various principles of 80/20 Investor to your portfolio on a monthly basis, on a 3-monthly basis, on a 6-monthly basis, or an annual basis. And this is what you would have ended up with. And I also looked at the investment statistics, and not just the overall return, but also the risk reward statistics of things like Sharpe. I'm not going to go into that today, but we are now 5 years on from that piece of research. So we've actually had 10 years of published data for 80/20 investors. So what I did is I went back and looked at that data and said, well, let's imagine somebody had started using the data 10 years ago and they'd updated their portfolio maybe monthly. Then we looked at if somebody had done it every 3 months, if somebody had done it every 6 months, and if somebody had only updated their portfolio annually. What would have been the differences in terms of the returns they would have got? Is there any difference, or would there have been any difference at all? And what the results do is not necessarily give you a definitive answer, but just give you some insight, and hopefully, I think, help people relax a little bit when it comes to investing. So let me just recap on what happened 5 years ago. I'm just looking at the data now. So 5 years ago when I did this, the monthly portfolio, where people were making changes every month, that actually outperformed the 3-monthly one, the 6-monthly one, and the annual one. And it was in that order in terms of performance. And that kind of makes sense, you might think, because you're applying momentum in this particular instance. So if you review your portfolio more regularly, then you might actually be able to take advantage of that momentum. But the reality is that the difference between the 3-month and the monthly versions was only minimal even back then, and that was over a 5-year period. So at that point, the return we're talking about was about 42%. That's 42% profit over that 5-year period. And the portfolio, if you update it every 6 months, actually had about a 30% profit, whereas the annual one was actually only sitting on a 22% profit. So the takeaway was that if you are going to apply momentum, that you can let it run for a bit. You don't have to make changes to your portfolios every month. And when I manage my own portfolio on 80/20 Investor, I actually don't change my portfolio all that regularly. I actually change odd funds maybe every month. I review. I might change 1 or 2 or maybe none. So it does mean I hold funds for a relatively long period of time. Sometimes it could be a year or 2. Often I'll have them probably for about 6 months, and I might then change them in time. Now that I've gone back and looked at the performance of those various types of review periods over 10 years, the results are actually slightly different, and it's quite surprising. So the winner was actually the 6-monthly review period. The second place one was the 3-monthly review period, and the monthly review period came third, and the annual one came fourth. So what we're talking about here is the 3-month review period and the 6-month review period. There was hardly any difference. So the profit after nearly 10 years was 96%. They were basically both bang on that. The portfolio where we review things monthly, that was up nearly 91%. So it wasn't massive difference over 10 years. But what it does show is that the takeaway for most people is that you don't have to fret about reviewing your portfolio, making changes every month. Doing it 3 months or 6 months is sufficient. And actually, even if you do it annually, although it underperformed, that was up 82% in terms of profit over the 10-year period. So I would say to most people, review your portfolio at least annually. 6 monthly is enough. And even if you are a buy and hold investor, it doesn't hurt to review your portfolio every now and then. Interestingly, for anyone listening to that, they must bear in mind that although that's a long time frame, 10 years, there is a definitive start date to that period and an end date. Throughout the 10 years, the 4 portfolios that I mentioned had been vying for top spot. And actually, if you go back to the end of 2023, the monthly version that was reviewed every month, when I say the monthly version, that's what I mean, that one was in the lead. And that was because we'd seen a bit of a pullback in markets. So sometimes when there is a bit of a wobble in the market or a change of some kind, then reviewing the portfolio more regularly can work in your favour. Now, the annual portfolio, the reason that really was the laggard, because it got hurt when the Brexit vote happened, because it was positioned in a lot of UK assets at that point. And then when the Brexit vote happened, obviously the pound crashed. So if you had overseas holdings, then your portfolio exploded higher. So as the portfolios that had been reviewed more regularly in the lead up to that Brexit vote, they had positioned into overseas assets, and of course they benefited. So even though the Brexit vote was a long time ago, we're talking about back in 2016, the annual reviewed portfolio has still not caught up from that, even though it interestingly outperformed all the other portfolios during the pandemic crash. And that was because it was quite defensively positioned compared to the other portfolios that had been regularly reviewed and actually moved into more cyclical sectors in terms of equity markets. So when the world closed up because of the pandemic, then they slumped harder, and actually the annual portfolio, the one that was only reviewed annually, outperformed over that period. So it does depend on what time frame you pick. The message really to take away from this is you don't need to really panic about reviewing your portfolio every month or making changes every month. When I say review, I'm really talking about changes. Of course, you can review your portfolio and see how it's doing, but you don't have to keep tinkering with it on a monthly basis, and you can leave it for much longer, 3 months, 6 months, even annually. And I think most people would look at their portfolio once a year, and even if you only do that, the evidence suggests that that would be sufficient, and it doesn't become a complete detriment to your portfolio's performance. And in some instances, you will benefit from that less, I suppose, knee-jerk reaction to portfolio management. But I suppose the other takeaway to bear in mind is that the shorter your time frame, so if we go back to the original research, that was over a 5-year period, then making changes to your portfolio more regularly obviously help the portfolio performance at that point. But over the long term, it starts to be more about being in the market and having that diversified portfolio, because all of these portfolios I'm talking about were diversified portfolios.
Okay, so let's move on to the next piece of the podcast then. And we're going to be doing a quick piece talking about when to get financial advice, because we had a question from a listener that was specifically talking about advice for pensions. So Frankie said, can you please cover on the podcast how much we should expect to pay for pension advice? So we will cover that in just a second. But before we do, I thought I would quickly cover over when you might need advice in general terms, and then we'll look more at pensions. So the first thing we would say that if you have little in the way of savings and no private pension to speak of, then it potentially doesn't make sense to seek professional advice in that sense. You're obviously at the start of your journey. There are lots of things you can do. You can make sure that you're not in any debt. You can build up your emergency fund, and you can do those simple things in terms of starting to save that emergency fund and making sure that you're in a pension. So if you're at the start of your journey, pensions advice and general advice, it probably isn't worth paying for. But when it can make sense, we'll cover off a few of those examples. So you could consult a financial advisor for these reasons. And we've got a few bullet points here. Now, all of these things that we're mentioning in this particular part of the podcast, they do come from articles that we've got on Money to the Masses. We've updated quite a few of those recently, and we'll put links to those in the show notes. So let's cover off just a few quick bullet points. So if you've inherited money recently or received an unexpected large sum, that could be a reason you'd seek advice. If you're planning for your children's future, if you're planning to pass on money to family or friends, perhaps you're going through a divorce, if you have a spouse or family member that has passed away, again, you might need to seek advice for that. If you're acting as a trustee or as an executor or a power of attorney for someone else, if you're considering whether to consolidate pension pots, if you want to consider consolidating any legacy ISAs, for example, if you've got lots of ISAs in different places, and also if you're planning to invest your pension or planning to retire and you want to plan how and when to take the benefits from your pension. So that last one specifically kind of covers off where the question comes in from Frankie. So in terms of pensions advice specifically, it's important to know what kind of scheme you have, what kind of pension scheme you have, because if you're in a final salary scheme, which is also known as a defined benefit pension, there is a legal requirement for you to seek financial advice before transferring your pension to, say, a SIP, which is a private pension, only though if the funds are worth more than £30,000. So that's a key bit of information you need to know. Again, there's lots of information about that within the articles that we have on Money to the Masses. We're not going to go into great detail about that, but that's something to consider. So let's move on to pensions advice specifically then. I'm going to again read off some reasons why you might want to consider advice. There's a list of bullet points here. So if you're monitoring your pension on an ongoing basis and you don't feel comfortable doing that or don't know what you're looking at, then obviously someone who's specialised and qualified and can give you independent advice, that would make sense. If you just want clarity on how much money you need to comfortably retire on, that's another great reason. If you're ensuring that you will have enough for your retirement, again, seek advice. If you're budgeting and modelling your cash flow ahead of and during your retirement, a key thing there is to understand what you will need. Advice will help you out. Again, if you're deciding whether to buy an annuity, now an annuity is a product where you will take the pot that you've built up and you'll actually purchase a product, and in return they will give you a guaranteed income for a certain amount of time. There's lots of different types of annuities. I would almost definitely recommend you get advice if you're purchasing annuity, because there's lots of moving parts and things you need to consider there. If you're deciding when to make withdrawals and how to make withdrawals in a pension and make them tax efficient, then obviously advice will help. And generally just understanding how to manage a pension portfolio, specifically when moving towards drawdown, that is another good reason to take advice. And the last thing I would say about taking pensions advice is you can use something that's called the pensions advice allowance. Now, that is a specific amount that you can take out of your pension. You can withdraw up to £500 3 times once in any given tax year in your lifetime, and it means you can access advice at various stages in your life and not have to obviously pay tax on the money that you're drawing out of your pension to then pay for your advice.
So, I mean, I think you've done a brilliant job there, Andy, summarising that. So obviously, people listening to this podcast know that's the world that I came from. So I know the value of advice. And now, you've obviously not been able to give every possible scenario where advice is useful. I mean, obviously there's a whole host of things in relation to tax protection. If you want insurances, for example, you should speak to a specialist about those sorts of things. Mortgage advice, obviously, but in terms of investments and pensions, I think you've covered most of them. Now, an advisor should be able to tell you whether they can help you or not, or whether you need advice, and if they think you don't, then they should be able to point you in the direction of some services or guidance that you will find useful. So it is always worth getting in touch with an advisor anyway. Now, I think the value of advice is really important, I think, and is evident, particularly when you get to retirement. You mentioned it there. I think a lot of people would confused about the options that you have when it comes to accessing your pension. And the thing I would also say is pensions have always been the area that seem to be changed most when it comes to legislation over time, and that is a result of different things that maybe governments are having on their agenda. So in the lifetime that I've been sort of working in this industry, I've seen a whole host of changes that have happened, and each time there is therefore some impact on people's legacy arrangements. So as you mentioned, generally speaking, if you are new to saving and investing, putting money into a pension, the products that you are able to have access to are relatively simple, and you are just concentrating on putting as much money in there and building for your future. Of course, if you go and see an advisor, they'll tell you if they can help you, but advice really comes into its own when you've got legacy from before. So you've got legacy products, maybe old pensions, it could be company pensions, for example, from various different jobs. That's when seeking advice really can help, and it can stop you making mistakes, because that's the thing. An advisor can tell you about the things that you don't know. So there's issues that you could inadvertently cause by implementing a transfer or change to your pension. So I think that is a great summary that you've done there, Andy. Obviously, you've got mentioned about the pensions advice allowance. I'm taking you're going to now move on to see or to explain what the typical charge you can expect for any advice in relation to your pension.
Yeah, so I'll quickly go through some costs. Obviously, the cost varies massively depending on exactly what your situation is and how much help that you need. Looking at hourly rates that financial advisors charge, it can be anywhere up to about £350 per hour. but the average, according to Money Helper, is around about £150 per hour. Now, most financial advisors will offer an initial consultation, potentially for free, before then letting you know what their charges are and how much help you might need. They may charge what's called an upfront fee after the initial consultation in order to take you on. Sometimes it will be called an admin fee, and that could be anywhere between 0.5% of your assets up to 5%. Now, looking at some details that Vouched For, which is an online database where you can go online and search for financial advisors in your area, they've created some averages that advisors cost because obviously they've got the database where they can crunch the numbers. The average upfront or admin fee that a financial advisor would charge is about 1.86% of your assets. They then have something called an ongoing fee that some advisors will charge, and that could be a monthly management fee for sort of looking at your sort of portfolio, and that can range anything from nothing up to about 3.5% of your assets. And that ongoing average fee, according to Vouched For, is approximately 0.77% of your assets.
Yeah, so as Andy said there, that is typical of financial advisors. So they will charge maybe an upfront fee that you can negotiate, but they'll also have that ongoing charge that will pay for the service that you have ongoing as well. So it'll be things like annual reviews, for example, of your portfolio. So that is important to understand what that charge is, because that's going to be on top of any other charges that you pay on your investments. But also you have to understand that they are negotiable, and you can also shop around. So if you want to go and look at different advisors, like Andy mentioned, Vouched For is a service where you can find advisors based on customer ratings in your area and who have the expertise that you require, and then you can compare them, and therefore you could go and meet more than one of them and shop around and find the one that suits you. It's always handy to have a recommendation of a financial advisor as well if you're somebody you know that uses them and they are happy. But of course, do look at their reviews on Vouched For as well. But they are the ballpark fees. But the key thing to remember, as I said, is that they are negotiable, but you should talk to the advisor so they can explain their charges to you and justify them.
Yeah, and just to finish off the piece, because Frankie asked specifically about pensions advice, we looked at Unbiased this time. Now, Unbiased is very similar to Vouched For. They have a panel of advisors on their website. Again, you can search by your postcode or by ratings. And they've come up with some figures in terms of the one-off fees that you will pay for specific pensions advice. So advice on a pension where you contribute approximately £300 per month, they say the average fees to get advice on that would be £500. Advice on a defined benefit pension based on a transfer value of £100,000 comes in at around about £2,500. So if you look at £100,000, that's roughly 2.5%. Retirement advice on a £250,000 pension pot comes in at around £3,000. And a fee for consolidation pension pots that are worth a total value of around about £500,000. They say that the average cost of giving you advice on that is £5,000, so approximately 1% of that pension pot value. So there's some ballpark figures. They're not exact. They're not going to be the exact figures potentially that you would be charged, but it gives you an idea on what pensions advice costs.
Yeah, and the other thing just to throw out there may be people thinking, well, can you get an advisor just to work as a one-off fee for general advice and not have to have ongoing charges? Theoretically, these things are possible, but you're going to have to find an advisor that would want to do that. And you have to realise that this advice isn't free. There's also the administration that goes into the advice itself as well. So all things are technically negotiable, but you have to realise that there is a value to advice, even though you may feel sometimes that it is expensive. But that's why, as Andy mentioned, it's worth getting it in certain scenarios where you do get the real value out of their expertise. So Andy, I think you've finished that piece. I'm going to kick on straight into the final piece on the podcast, something slightly uplifting. It kind of leads on quite nicely from one of the pieces I did on the podcast a couple of weeks ago, which was in relation to doing one thing differently to try and improve your situation. So in that podcast, I gave an example of that maybe you weren't somebody who saved money, that you would start to save a small amount, and that would change you from somebody who wasn't a saver to somebody who had become a saver. And once you started doing that, even a small amount, then you are more likely to increase that, and actually you'd feel a lot better for it, and you start becoming somebody who's trying to protect their future. Well, interestingly, that I mentioned that, I then stumbled across an article on the BBC website in the last week or so that actually talked about some research that had been carried out in relation to improving your sleep. And the research was, or the report was, produced by Bristol University, and they looked at a whole range of studies. And the key takeaway was that saving money regularly can improve your sleep and overall well-being. And they found, when they looked at the studies, that putting aside a monthly amount, regardless of how small the sum is, that it helps people to relax and feel more optimistic about the future. So it feeds quite nicely on from what I was saying, but actually there is a mental as well as a physical benefit from doing that. And what they found is that even regular savers with low incomes had a similar life satisfaction level as wealthier non-savers as a result of their savings. So it just shows you the impact of making a small change, like starting to save money, what that can have on people. And they looked at the reasons, and they obviously found that people had a better life satisfaction because of the saving, but it reduced anxiety about money, it decreased the likelihood of problem debt, and it also enhanced their ability to handle unexpected events in the future. Now, obviously, you've got to caveat all of that with the reality that well-being is going to be impacted by lots of things, not just your saving. There's lots of life events that will have a big impact on your sense of well-being as well. But they did follow people over an extended period of time, and I think the actual period of time was 10 years, to try and ascertain the impact of starting to save money. So the message is, if you want to sleep a bit better, start to save a bit more money. Now, for people out there who don't know or aren't saving at the moment, there are easy ways to start saving, even just a small amount. And one of the ways is roundups. So you could decide just to put money aside yourself, but you could use services that allow you to round up the spare change when you use your card in a shop, for example, and put that into a savings account. You can, in some instances, actually invest that money with some of these services. But there are plenty of services out there that allow roundups. For example, Moneybox does it. We've got an article that I'm going to put in the show notes called The Best Saving Apps in the UK, How to Build a Savings Pot Using Your Smartphone. And basically, it gives a list of services that allow you to do some of this very automated saving. Now, there are services like I've mentioned already, Moneybox, that I mentioned in the article. Another one is Plum. There are some app-only banks out there that do roundup. So Starling Bank and Monzo both do it. Revolut also now allow roundups as well. And Chase Bank does as well. So we're going to put links to that article in the show notes. So what I want people to do is to do that one thing and actually round up their loose change using something like roundups, or start to save money. Now, just to give you some insight, even though I do put money aside myself each month, I do also use one of these roundup services because I do like them. It's a way of just putting some money aside and putting it maybe for something like Christmas or whatever it may be, and almost forgetting about that pot of money. So I still do it even though I put money in savings and investments, because I think it's a neat way to have some additional money, a little bit of a buffer there as well. So do that one small thing to make yourself feel better, and hopefully if it's related to saving, it might help you sleep a little bit better too. So, Andy, that is it for this week on the podcast. As I mentioned at the start, thank you to everybody that reached out this week. Made me feel a lot better about things. Please do leave a review on the for the show on the podcast app that you use. Do also follow us on Instagram, TikTok. I'm loving both those platforms at the moment. I put a lot of stuff on there that isn't on the podcast. I'm also putting little clips from the podcast. I mention it now. There is one clip that I put on the podcast, or from the podcast, on TikTok, that has had nearly 100,000 views. So if you want to see what that's all about, go and have a look at that over on TikTok. Please do make sure you follow us. Obviously YouTube, we're putting stuff out there all the time. I've just done an update to our free trade review on YouTube. Do join our Facebook group, facebook.com/groups/money to the masses. And Andy, I think I've remembered everything. I was trying to work my way through them. I think I said leave a review. Is there anything else I forgot, or is that it?
No, that is it. So Damien, you've done a brilliant job there, and we are done for this week's podcast. So all that's left to say is until next time.
Until next time.